what are the upside or downside risks? And I just want to cover these for you. On the downside, I'd say is a cascade of related events, and I'll just cover them in some random order, but a deleveraging cycle may be underway, and people fear that this is also going to be a tightening of financial conditions that leads to a recession and possibly a financial crisis. And in terms of recession risk, before the delay, the tariff delay, Polymarket was putting the odds at 68%. They fell to 48% after the delay, but have actually since gone back to 58%. I would say something over 60% is considered DEFCON 3. Something closer to 70% is DEFCON 4. And when you get to 80%, pretty much the market is telling us it's a guaranteed recession.
Tom Lee begins by explaining the origin of the recent market turmoil, Tariff Liberation Day. This was the day the U.S. government dropped a surprise bomb on global trade by announcing reciprocal tariffs, a calculated reciprocal tariff rate of 20% across the board, a number that shocked global markets. While a brief delay in implementation gave investors temporary hope that the effective rate might settle closer to 10%, a deeper read of the executive order revealed otherwise. The real story was that only a modest reduction in tariffs would occur, particularly due to steep punitive rates still targeting China. In short, global markets were caught off guard, and it didn't take long for the fallout to begin.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So let's start with Tariff Liberation Day. And there are many things that I would want to cover, but these are the 6 points I do want to speak about, which is why have global markets suffered such instability after Tariff Liberation Day? Well, the first reason, I'm sure you've heard it in the media, the proposed tariffs are just derived from an absurd formula. It's not really a measure of the reciprocal tariffs imposed by the other country, but rather it's some way to measure what appears to be their attempt to close the trade deficit itself. But it's a very blunt and very unconventional way to calculate that tariff rate. I'll just give you an example. The calculated reciprocal tariffs imposed on Tariff Liberation Day was 20%. Now, earlier this week, on Wednesday, April 9th, there was a reprieve given, a delay of implementing the reciprocal tariffs. And so markets kind of celebrated because they thought the tariff rates that would be ongoing would be roughly 10%. But as people read through the executive order, and that would have been on Thursday, the markets realized that actually there's only a modest decrease in the total tariffs on imports, and that's because of the punitive rates applied to China. The second reason markets went into instability is because the covenant of capitalism is broken. Now, we've written about this at FS Insight and at Fundstrat, but the point here is companies, when they're in a capitalistic environment, expect to earn a return on invested capital. But what they need from the government is predictable and stable regulations, so they aren't stuck with stranded capital, and it gives them a willingness to invest capital in a country. Remember, a dollar that they put into the ground, whether it's for R&D or a plant, has a 7 to 10 year life. They need to believe that the environment for regulation and tariffs, etc., is stable throughout that period of time. The third is Liberation Day gave zero notice for any of the global trade partners, businesses, or multinationals. I thought this essay by Neil Dutta at RenMac was good, but the one point I like to highlight is starting a skirmish with Canada, Mexico first, and instead of China was pointless. Basically, the execution, and many have criticized it, hasn't been great. The fourth reason markets went into a tailspin is that the architect of Liberation Day looks like it was Peter Navarro and Howard Lutnick, who are viewed as ideological and not necessarily economists. keep in mind that there's several factions in the White House, but on the tariff maximalist side is Navarro and Lutnick. And on the right side is advisors like Bessent, Treasury Secretary Bessent, and Elon Musk. And the good news is earlier this week when they made the 90-day pause, we didn't see Navarro or Howard Lutnick in sight. So it looks like the White House exercised the Navarro call, which means giving the curtain call to Navarro. In terms of negotiating, the fifth is the Federal Reserve is sidelined for now. Usually the Fed comes to the rescue when markets become unstable, but that's because they're trying to understand the impact of tariffs. Last week, Fed Chair Powell said this on Friday. Markets got nervous, and we had several Fed people speak this week, and they've all echoed the same thing, which is they're not willing to take chances when it comes to maintaining the Fed's credibility on inflation. So until they know if tariffs are going to be inflationary or not, the Fed is on hold. And lastly, all of this uncertainty has triggered pretty big deleveraging across global markets. This is the swap spread, a very popular hedge fund trade. And as you can see, that spread has actually widened dramatically. And this is a bad deleveraging unwind that was reaching a crisis point on April 9th. We had the delay and the spreads actually improved dramatically. But on Thursday, they began to worsen again. Okay, well, with all this in front of us, you're going to ask yourself, what are the upside or downside risks? And I just want to cover these for you. On the downside, I'd say is a cascade of related events, and I'll just cover them in some random order, but a deleveraging cycle may be underway, and people fear that this is also going to be a tightening of financial conditions that leads to a recession and possibly a financial crisis. And in terms of recession risk, before the delay, the tariff delay, Polymarket was putting the odds at 68%. They fell to 48% after the delay, but have actually since gone back to 58%. I would say something over 60% is considered DEFCON 3. Something closer to 70% is DEFCON 4. And when you get to 80%, pretty much the market is telling us it's a guaranteed recession. And people worry about a protracted war with China. Now, I know the White House says that they have all the cards, but as the Chinese say, they have this concept called eat bitterness, which means since they were young, they've learned to tolerate pain. And that's what China is basically saying, that they can wait this out. Now, there are positive risks as well. And I think this is something you need to think about, because I don't know if markets are really thinking about the positive risks. The first is that once we get the first trade deal signed, it may be a template for all of the others, and the market's going to breathe a sigh of relief. In fact, you might even have some inklings of overtures to China, because President Trump on Thursday at the Rose Garden said, in his White House briefing said, we'd love to be able to work a deal with China. I think we'll work something out that's good for both countries. I look forward to it. We'll get a phone call at some point. I mean, sounds like he's open to talking. There's a possibility Trump capitulates. Now, it doesn't mean he's going to give up the tariff deals, but he's going to find a way to declare victory. I mean, we got the first hint of this, and even on Thursday he says he doesn't rule out extending that 90-day pause. That's not a bad thing, again. The third is he might scapegoat somebody. And Politico carried a story on Thursday that Bessent is leading on trade and Lutnick is playing the bad cop. So again, not only is the Navarro call exercised, but possibly one for Lutnick. Now, these are related. The Federal Reserve or a global central bank could panic because we know currencies are moving. Stocks could stop falling on bad news. That would be a good sign. And finally, keep in mind there is a tax plan and deregulation ahead. So there are positive risks.
Given the high uncertainty, Lee suggests two approaches. Be tactical now, but think long-term tactical strategy. Preserve capital during this hyperactive period. Social media and algorithmic trading are amplifying every headline. It's wise to stay nimble and protect against downside risks in the short run. Long-term strategy. Once the dust settles, opportunities will arise. Lee references Warren Buffett's famous line, "In the short run, the market is a voting machine. In the long run, it's a weighing machine." He believes U.S. companies remain the strongest in the world, and investors should prepare to take advantage of undervaluation once volatility subsides.
And this comes down to strategy again. Do you want to be tactical or do you want to be investing? Now, what I mean by tactical is, and it may be appropriate now because of the elevated risks, but you want to focus on capital preservation because markets are hyperactive. I mean, social media creates large price swings. You might be waiting for stocks to bottom, and you're probably interpreting information half empty, and policy change would flip the script immediately. Okay, but here's the thing. There are going to be opportunities created for long-term investors, okay? Remember what Warren Buffett said, in the short run, the market's a voting machine, but in the long run, it's a weighing machine. The US has the best companies in the world. In fact, our Granny Shots is finding the best of these companies that are exposed to important themes. So in the short run, you might think you're tactical, but in the long run, it doesn't matter as much. It's a weighing machine. Second is that you really are better off buying stocks when volatility is high. The VIX 52, I mean, that's a huge number, as you can see here. And it's, the VIX term structure has gone absolutely bananas because the spot and the 1 month are way above the other contracts. But whenever you get this inversion, the VIX term structure, okay, and there have been 11 of this size or more, not a whole lot. Look at the 1 week, 1 month, 3 month returns. They're all pretty good. You want to buy stocks when they're below their 200-day moving average. I'm sorry, when that number is below 20. It actually hit 14% this week. It's kind of rebounded a little. But take a look at this. There are about 60 instances when this has taken place, okay? But in the last 10 years, 6 months later and 12 months later, 100% of the time, you actually you had positive return buying when this percentage is below 25%. Now, another thing is we're probably getting close to the point, I'm not going to say we're there yet, for stocks to be in sold out conditions, not oversold. Walter Deemer coined this phrase. He says oversold markets are ones that have gone down a lot, and sold out markets are ones where there's no more stock left to sell. Okay. And he goes on to point out, a sold out market has gone down a whole lot, but there's not more stock left to sell. The news is terrible, the outlook bleak, but there's just nothing left to come out. I think we might be seeing this with Mag 7. It looks like on a relative basis to the S&P, they bottomed on March 28th, so about 2 weeks ago. And on April 8th, you can see when the market had that panic freak out, made a higher low. It's almost to me suggesting it's sold out. Same thing with high beta stocks. They bottomed on a relative basis April 4th. And actually, as you can see, have been finding support even on April 9th. So is that sold out? I think so. Well, what about granny shots? I thought it'd be helpful, and Tireless Ken is going to cover this in more detail in the next section, but when you look at global exposure, especially to suppliers, few of the companies have significant exposure to China. Of the 33 stocks, 2 stocks have more than 30% supplier exposure to China: GE Vernova and Tesla. What we mean by that is, as you can see on this chart, for GE, roughly 30% of its parts come from China, Tesla, 25%. Tesla has a strong relationship with China, and GE supplies critical infrastructure. I think that they do have pricing power there. Now, there is some strange news for the Model S and X, which aren't the high volume sellers in China. They have suspended taking orders on their website for China. But as you can see, on a relative basis, China bottomed versus the S&P on March 10th, basically more than a month ago. And on April 8th, they held a higher low. So I think it looks pretty sold out or washed out. And GE Vernova, similar situation. It looks like GE Vernova bottomed on March 7th relative to the S&P. On April 3rd, had a retest but at a higher level. So is that sold out? Because that's, again, a month ago. 9 stocks have 60% supplier exposure domestically, which is kind of a good ratio. Top of the list are names like MicroStrategy, Palantir, Progressive, CrowdStrike, really popular names. And as you can see here, MicroStrategy and Palantir are 100% US sourced companies. So just to cover this, you may not be sure what a granny shot is. It's referring to an unconventional way to do a basketball free throw, popularized by Rick Barry, who made 90% of his free throws. The way we do granny shots in the stock market is we look at the most important themes that are multiple year drivers of the economy, like millennials, global labor suppliers, and the rise of AI and automation, energy and cybersecurity, or easing financial conditions. And we have tactical themes like style tilt, seasonality, and the PMI recovery. To be a granny shot, not only are you in one of these themes, but you have to appear in more than one theme. And so stocks appearing more often are considered the granniest of granny shots.
Lee also introduces the concept of sold-out markets, conditions where there's simply no more stock left to sell. Stocks like the Magnificent Seven and high beta names are showing signs of forming higher lows, which may indicate these stocks have already bottomed. Finally, Lee discusses granny shots, FundStrat's thematic stock strategy that emphasizes multi-theme exposure. These are stocks that align with major secular trends like AI, cybersecurity, and domestic sourcing. Companies like MicroStrategy, Palantir, and CrowdStrike top this list, with heavy U.S. supplier exposure insulating them from foreign trade risk. Please like and subscribe.